Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. This show gets you actionable insight on everything personal finance related, and it's for a wide variety of individuals of different contexts. Ultimately, that is what makes personal finance personal. And today I'd like to talk about a growing trend. More and more couples are deciding to get married late, and quite a few are deciding to not have children. There is a term for it. It's called double income, no kid. And this is not necessarily always by choice, but largely we're hearing anecdotal evidence suggests that a lot of people are choosing this. We're not getting into why people are doing that. What we're discussing on today's program is how you should plan your finances if you are a couple with double income and no kids. Joining me today is Nisreen Mamaji, who is the founder of MoneyWorks, and also Vishal Dhawan, who is the founder and chief executive officer of Plan Ahead Wealth Advisors. Thank you so much to the both of you for taking the time. I want to actually start by asking both of you, Vishal, I'd start with you. In your own conversations with your clients, are you coming across more people than you did perhaps a decade or a couple of decades back that are in this kind of a situation where they've chosen to not have children?
We're definitely seeing a rising trend, and I think a lot of it is very deliberate because there are certain choices that couples are making together in terms of some of the freedom that they want, both in terms of their careers as well as some of the responsibilities that come with having children. And therefore, we are clearly seeing an increased trend in more and more people wanting to let their careers and their freedom dictate whether or not to have children.
Okay, so that answers my question. Nisreen, I want to come to you on this one. Let's start the conversation with identifying how it differentiates from the regular couple who decide to have children. And of course, biologically, it's the earlier you have children, and you're the best place to tell me that. The best time to have children is early for various reasons. What is it financially? And also talk about how things change if you don't have children.
So, yes, I think I would agree with Vishal that there is a rising trend for pet parents, actually. A lot of, my children's friends also are going in for, having dogs and cats and substituting that parental feeling, a maternal or a paternal feeling with looking after a pet or plants. So I would agree that this is a trend, and, either they are delaying children because both of them are working, and also they want to keep the, geographical mobility very high on the requirements list. So they don't want to get bogged down with, school dates and, geographical cities that you have to belong to because you have children. So there is a rising trend. I mean, it's not extremely common, but yes, there are young couples now who are, coming to MoneyWorks, and they are only talking about, their goals minus children. I mean, they're very clear that children are not on the cards right now and maybe later. So I think this is a phenomenon, it's a Western concept. My own nephew has also followed it for many years. He's been married nearly 4 to 5 years, and they have Toby, their dog, who is their child. So this is he lives in the US. It's a Western concept, and I think it is kind of carrying forward to India, but possibly in the Tier 1 cities. The Tier 2 and Tier 3 haven't caught on with this, but definitely a growing phenomenon, yes.
Okay, so then Vishal, the question is, if you are someone like that or a couple like that, then how should you approach? And let's assume that maybe they've started doing a certain amount of saving, they've been contributing to a corpus together, or they're starting fresh. And let's assume that if they have to rework their strategy, they can do so after this conversation. So how would you approach the first leg of it, which is setting your goals and identifying how much you can save on a monthly basis?
So I think a lot of the goals will be similar to couples who have children as well, and some of them will be distinct. For example, we see the need commonly for both types of couples to have a robust emergency fund just in case they have a health issue in the family, in case they have a job loss, any of that. I think one of the things that tends to happen with some of these families is that they may choose to take sabbaticals at different points in time simply because they want that greater flexibility. And one of the reasons why they don't maybe have children is because of the need for flexibility. And therefore, the more you want to build out to have that ability to take career breaks, sabbaticals, etc., the larger the need for that emergency fund to be well created. The second thing that does tend to happen is that a lot of these couples do want to travel a lot more. And because they want to travel a lot more, their requirement of monies on that list tend to be much higher. So we do come across families who say that, one of the things I want to do is travel to Antarctica, for example. And we don't have children, and that's a bucket list item that we want to achieve. Now, clearly, a trip to Antarctica requires a much larger amount of money and much more planning than what you would do if you were just to catch a flight and, let's say, go to the Middle East. So the way that planning happens around those goals can be different because of the quantum which is involved as well. And lastly, a lot of them do want to become financially independent and retire much earlier. So the FIRE movement is very commonly something that these couples look at. And therefore, the need for them to be prudent with the way they spend, the way they invest, how quickly they want to get to that financial freedom. All of those are important elements when they start planning their monies.
Yeah, I do want to point out that there is no judgment here, and there is no suggestion that this is the right approach or not. It's ultimately the couples that are deciding what they want to do. But having said that, I wanted to discuss a model portfolio and caveat before we do. This is not necessarily something that you should do just because we're talking about it, just to give you a sense of how to go about an ideal asset construction, and your context might actually require a different approach entirely. So do consult with your financial planner before you get into something like this. But Nisreen, I suggested a couple that is between 30 and 35 that does not have children, that is both earning. How would you set the parameters for constructing a portfolio, and give us a model portfolio as well?
Sure. So, here, Alex, we can assume that, possibly their tenure is higher because they are in the 30 to 35 age group. So therefore, their equity allocation would automatically be higher. They would possibly have a fewer, lesser current liabilities. So there's more room for growing of wealth. We need to have flexibility, but there's obviously, no requirement right now for, say, down payment. So their future goals would be like wealth creation, travel plans, etc. Early retirement, house, maybe, much later on. But currently, we would plan on, say, the medium-term goals, which could be wealth creation and travel and early retirement. And emergency funds, because, such a couple also would tend to take sabbaticals, as mentioned earlier, take longer vacations, take work also on project base where, they work for 6 months and then they're kind of not working the last 6 months. So a lot of couples have started this kind of, job structure also. So here what I would recommend is, say, a 70%, 100%, growth allocation towards equities, which could be possibly invested in, if you need the names of the funds, we could have, like, say, FlexiCap funds, we could have Parag Parikh FlexiCap or HDFC FlexiCap for about 20% of the fund allocation. A large and mid-cap funds for 25% allocation, which could be Miri Asset, Emerging Blue Chip, or Canada Rubico Large and Mid-Cap. These are the kind of funds that would be part of the 70%. So 20% towards FlexiCap, say perhaps 25% towards a large and mid-cap strategy, 15% towards a mid-cap strategy like Kotak HDFC mid-cap opportunities would be a good fund. And, we could also go sectoral or thematic 10%, where we would recommend, say, ICICI Innovation or SBI Consumption Fund. This would be like a tactical allocation. So your mid caps is focusing on higher growth and possibly will give you higher volatility. Your thematic and sectoral funds is for your tactical allocation. 10% could be, either ICICI or HDFC Balanced Advantage Fund. And also, say, a liquid fund. It could be ICICI or Nippon Liquid Fund. and a shorter term or duration fund to about 5%, which is your Kotak savings fund or your SBI arbitrage fund. So this 5% is basically for your emergency funds or your short-term liquidity. And you can also go 5% towards, say, a US or a global fund. So that possible suggestions are Motilal Oswal Nasdaq 100 fund of funds or a PGIM global equity fund. So this is for your currency hedge. So just to as a synopsis, 70% towards long-term capital growth, which could be equity funds, where I've already mentioned it's a mix of flexi cap, large and mid caps. 10% towards hybrid funds. This is just to smoothen the ride and to ease the volatility. 15%, which is for your emergency funding, which is long-term and short-term goals. Short-term and liquid goals, emergency funding 15%, and 5% is international equity, just for your global diversification and currency hedge. So that's your entire 100% model portfolio.
Okay, just to follow up on that, I notice in the international allocation you've done a Motilal Oswal Nasdaq 100 FOF, which is a fund of fund and not the ETF. I just want to draw attention here that ETFs, particularly those of Indian mutual funds that allow you to invest globally, like the Hang Seng Bees or even the Nasdaq 100, they do trade at a premium on the Indian exchanges. And so therefore, I'm asking, is the fund of fund route at this juncture better? Is that why you suggested it, Nisreen?
So, both the options are available to you. The exchange traded funds, you would possibly go to any of your, trade on your own through any of your apps, etc. And if you're taking a consolidated view, then the funds will gain importance, because then, your entire investment is viewable on one format, and also you're possibly your planner or distributor is also a single person. So for ease of convenience, a fund of funds would, was possibly recommended. Then you deal with one person for across the board. But if you also have a stock portfolio and you're also trading on your own, then yes, you can go for the ETFs also, which would make it convenient for you. So both the options are available for the investor.
But do bear in mind, of course, that those ETFs are trading at a premium to the NAV because of the kind of demand-supply gap that you're seeing in international funds that are currently available in India. Vishal, would you change anything, in your opinion, in that allocation that Nisreen just spoke about?
I think I just, maybe tweak a couple of things in there. Most of it is very much aligned with what we would think about. I think the fact remains in our experience that, because travel is such a large part of, couples who have no children's sort of agenda, that international exposure in our mind would probably tend towards 15 or 20% of a portfolio rather than about 5%. And the second thing that, we do continue to believe needs to find a place across all portfolios is some, gold exposure. As much as there is a risk that, prices today may be a little overdone, but I think from a longer term perspective, having between 5 to 10% allocation to gold or gold and silver is probably a good idea as well, even for these couples.
And through ETFs would be the best approach, Vishal?
Yes, ETFs are a good option. Of course, on the international side, there are a lot of challenges, some of what you mentioned already around premiums, etc. But there's also just the restriction that a lot of funds don't accept money at all. And therefore, that strategy may need to be thought through carefully on whether you want to do it domestically or whether you want to use LRS and buy ETFs internationally so that you're able to get access to those products.
And gold and silver through ETFs?
Yes, that's right. Gold and silver through ETFs.
Okay. So the other question, and Nisreen, you did allude to this while you were speaking about the goals that a couple might have. You spoke about buying a house. Now, a lot of young couples decide to live on rent for various reasons, particularly, as you said, in your metropolitan cities, your tier 1 cities, because prices of property are unattainably high, let's face it. Even if you're earning a significant amount of money per month, just the cost of acquisition makes it very, very difficult to achieve. So a lot of them choose to live on rent rather than buy a property because the mathematics just don't make sense. But at some point, do you think every couple needs to have a house? And at what point should you go ahead and buy something like that?
So, I'll summarize that for you, the pros and cons of buying versus renting. So basically, if you want to buy a property, then, you don't have any landlord headaches, rent hikes, lease terminations, the constant headache that, you have to move in a few years. So there's a bit of stability and control. And you can also customize the home to your lifestyle. So, if you're working at home, then you can have a small dedicated table there. If you like to, gym at various timings, you can, adapt certain areas for keeping a treadmill or certain weights, etc. Sometimes landlords have a lot of restrictions about, drilling in the walls, etc. So if it's, you can customize your home if you're buying a property. Also, this can be an asset creation. It's a long-term asset. There's potential appreciation over, 10, 15, 20 years. So, you can keep that into account. You can also, use this property for monetizing later on. So you can either sell this property, you can rent this property, you can use it for reverse mortgage, in your retirement years. It's also an inflation hedge. So real estate often keeps up with or exceeds inflations over longer periods of time. Over the shorter periods, we find that the rental yield for residential is only about 2%. And for commercial is about 5%. But over the 30-year period, you will find some appreciation as well. And there's no forced, retirement moves. Like, for example, if you have your own property in the city that you've been working in, then post-retirement, there is no other move that you have to adapt to another city and, get reused to living and working, in a different area in the retirement phase. That also gives you ease of mind while you are planning and during your accumulation phase. Also, you can use it for like a legacy for your children, or if you don't have children, then, charity purposes. So you can build that property going forwards, to whatever you desire. If you have children, then obviously that way, and otherwise, for charitable purposes. Now, the disadvantages typically would be, reduced flexibility. Now, it's harder to move cities and take sabbaticals or explore, global living options. Like I think Vishal earlier spoke to, say, a trip to Antarctica. I do have some investors who live 6 months of the year in Uttarachal, where they kind of just, rent a place and then, in the beautiful climate, Uttarakhand, and then, in the mountains, and, they're writing over there, they're working remotely. Now, if you have your own property, you can't have this kind of a lifestyle.
Yeah.
So it depends on the lifestyle that you choose.
So all of those points are very valid, Nisreen. Apologies, I'm cutting you off, but what I want to get at is the security of having your own home. At some point, these couples, even if they don't have children, will have to stop working, will have to stop earning, and so therefore paying a rent is going to be difficult. So therefore, they would eventually have to buy a home. At what point do they decide to do this?
So, it's an emotional and financial decision, to be very honest. So I think, for people who are in their mid-30s or approaching 40, if that is the time that they could be looking at, buying their own property, maybe a little later, because the difference in the EMI and could be invested in a very good SIP also. Now, if you're buying a property, say about 1.5 crores, say in Bangalore, 1.2 crores, your down payment is about 24 lakhs. And, you've taken a loan for the balance 96 lakhs at, say, 8.5% interest for, say, 20 years. So your EMI would be 83,500 a month. Vis-a-vis a rental property that you would be doing very similarly would be somewhere, 30, 35,000. So the difference in the in your investment amount is about 48,500. So if you were to invest that into an SIP, for example, plus, if you buy the property, then there would be some down payment that you have to put down, say about 20%, around say 24 lakhs. So when you do the math, the later that you buy and the higher amount of SIP that you invest in will possibly, you'll be able to buy a outright purchase, say 20 years later also. So you don't have to go through that, EMI route right from your 30s. So as per the theoretical calculations, if you are around 40 to 45, and from the age of 25 to 45, you've invested in very good SIPs, which had yielded you, say, about 11% compounded annualized growth rate, then 20 years later, you will have about, say, 6 crores in your account if you've invested about 50,000 per month in an SIP. So you can do an outright purchase at that time, and you need not have gone through this down payment and EMI route.
Yeah, it's an important point. Vishal, so therefore, just to drive home this point, compounding works beautifully once you've achieved a certain scale. And so would it be okay to say that at the early start, at the early part of their life together, if a couple is focusing their efforts on building this corpus and letting it grow over a period of time, they don't necessarily have to rush into buying a property. They can do so towards the latter part of their careers, which in several cases is around 50.
No, I think, one of the reasons why a lot of people have, first of all, made the choice not to have children is because they want more flexibility in terms of their jobs, their travel, etc. And the moment you buy early, you tend to get tied down. The EMI sort of holds you back because if you want to become an entrepreneur, for example, you're worried about supporting the loan. So all of those things are actually going against your original thinking. And therefore, I think making this decision later is a good idea because it then allows you to make that decision after you've finished with a lot of your job and career related decisions. And you're making this choice now basis a lot of other new things that have emerged for you. For example, as you get older, you might decide that access to good healthcare could be a primary decision point, or you could decide that being closer to where my social network is, my friends, etc., because I don't have children, might be an important decision point. So I think making that decision later on typically tends to work well, even from a non-financial perspective.
Okay. Now, beyond the scope of what we just spoke about, which is about double income, no kids, I did also want to talk to you about the key mistakes that people are making in their investing journeys. And it's interesting that we speak about this because I saw in the latest data from the Association of Mutual Funds that the number of discontinued SIPs has actually gone down quite dramatically. It's lower than it has been in the recent past, which bodes well. But having said that, the net inflows into equity mutual funds last month was not the best. And that is because of geopolitical tensions and everything that panned out. And that just drives home the point of the impact of behavior. So let's talk about a few of these things. Incidentally, I asked both of you the same question. You've come up with the same list, more or less. So let's start one by one. You both listed chasing past performance. So we'll just ask one of you to do it. Vishal, why do you say this is the most important one to focus on?
So I think it's reasonably common to see a recency bias come in, and I think we're all sort of prone to that risk. And this happens across asset classes. It could be happening across equity markets, when you're making mutual fund decisions. Gold has done really well. There's a lot of money wanting to buy more gold. Real estate has gone through a good cycle. So, everyone sort of assumes that the future is going to be like the past. And the risk in that model is that you very often tend to buy at peaks and also exit at troughs automatically because of this thinking. And we need to keep in mind that a lot of how asset classes behave do tend to be cyclical in nature, which means that there are both global as well as local factors dictating how they perform. And therefore, just looking at past returns rather than thinking a little forward in terms of what is happening and whether that good performance or bad performance is likely to continue is a very, very important thing that investors need to protect themselves from.
That ties into the second point that Nisreen has made, which is a lack of asset allocation, in which he's talking about the requirement to have a holistic approach to building a portfolio. I'm going to skip past that because it kind of ties into the first one. And don't tweak your portfolio every second month. It's counterproductive. The third point is ignoring risk tolerance and time horizon. And this, I think, is pretty self-explanatory as well. Let's run through them quickly because we're running out of time. Important point to make, Nisreen?
Sure, I'll just tell you this with an example. There was Sunil. He was 38. He was working in IT. He invested about 10 lakhs from a recent bonus that he got in an aggressive equity fund, and he was actually that was required for a home purchase in about 18 months. The markets corrected, and his investment dropped to 8.5 lakhs. So then he had to dip into his emergency funds and borrow at high interest, etc. So it's very important for one to know, the eventual goal that you're actually investing for, to know your risk appetite and your time horizon both, and tie it up into the investment while you're doing that. So I think that was, well explained with Sunil's example.
Okay.
Alex.
Yeah. So there are a couple more to run through. One is underestimating liquidity needs. And I think a lot of people realize this a little too late when they don't have a choice. And this is the emergency fund, I guess, that you're talking about, in the available liquid assets. Vishal, is that right?
That's right. So one is the emergency fund, and the second is there are just certain types of asset classes which tend to be less liquid. For example, real estate, or when you buy certain types of long-term bonds, they may not be liquid at all. Or there could also be other assets like equity or cryptos, for example, which are very volatile. And therefore, when you need the money, they may not be at a price that you're going to want to sell them at. So I think it's important to ensure that you look at risk and return, and you look at liquidity, and don't underestimate, the importance of liquidity when you're making decisions.
Yeah, and both of you have identified behavioral traps, and Nisreen, you've pointed out acting on emotions, which is fear and greed. Ultimately, that does determine market moves. But a lot of investors have proven that if you hold and if you stand the test of time, that is a better approach than trying to time the market and move very quickly to take advantage of short-term spikes or falls. Both of you, thank you so much for joining me today. Absolute pleasure having you on the program.
Thank you so much.
All right, well, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in, and do stay tuned. Lots more coming up on NDTV Profit.